And the man who steered AMP through the $14 billion AXA acquisition is Chief Executive Craig Dunn. I spoke to him earlier. Craig Dunn, welcome back to the programme.
My pleasure.
Well, the market liked your underlying profit figure, and I know you prefer it because it ignores things like market volatility. But isn't it just as important to look at net profit precisely because of the volatile last 6 months?
Yeah, well, I think the point is the underlying profit gives you a better indication of the underlying trends in the results of the business. The very bottom line is always important, and it's been also impacted by changes with the AXA merger. But I think the pleasing thing about the result today is we had a resilient outcome in underlying profits. It was up 3% like for like. And even more importantly, Ticky, what we've been trying to do as a business over the last few years is very much focus on building the growth platform of this business and continuing to make it a more competitive business.
I know your outlook for the stock market is continued uncertainty and volatility. Would you put this as a major reason for these dramatic cash outflows? I'm looking at AMP Capital Investors down to 247 million from 1.96 billion, and AXA net outflows increasing from about $500 million to $1 billion.
Well, I think what you're seeing in those results is consistent with the rest of the industry, where there's significant investor caution and significant caution in the community among consumers more generally, and you haven't seen a strong recovery yet in the net cash flows coming into the industry beyond the 9%.
Is it also a sign that you're perhaps not writing enough new business, though?
Well, no, I think the results say the opposite. I think against the rest of the market we're doing very well. If you put the result in the context of the market in which we're operating, as I said before, there's some very strong trends coming through the business that demonstrate the growth investment that we're making is paying dividends.
Just on the AXA merger, how much more are you going to have to spend in order to save more? It must be a very tricky balancing act.
Well, what we've said today is that having now been a part of the merged group and having AXA in the larger group for the last 4.5 months, we've been able to do more detailed planning, and we're more confident now that we can deliver a higher synergy target of around 140 million post-tax. We've also said that to achieve that additional $20 million benefit from our earlier estimates, we're going to have to invest some more in one-off costs of around 25 million, and that's a one-off cost for a recurring benefit of 20 million.
NAB have made no secret of its attempts to poach AXA financial advisors. What are you offering frontline staff over and above what MLC has to offer?
Well, I think from the board, CEO right down, our whole business is about financial advice. We've led with AXA the shift away from commissions. We've led the investment in bringing new planners into the industry with the Horizons Academy. And we're a partner that very much believes in what advisors do. We're very much partnering with them to grow their businesses and improve their outcomes for their clients. And I think that's why you're seeing very good retention advisor numbers, because of that shared commitment to a growth strategy going forward and improving outcomes for Australian consumers.
Elsewhere in the business, to what extent are you going to have to cut staff as part of the integration?
Well, as a part of the synergies, we've said from the outset there will be the removal of roles that are being duplicated, and that will have an impact on some people's roles. We're working very hard to make sure that that impact is limited by utilising natural attrition wherever possible.
Just on the new FOFA regulations, you said today that you don't support the customer opt-in because fees are dropping anyway. But isn't a real reason that you're a big player, and big players and their shareholders want to push their own products, and you've got a fundamental conflict of interest?
Well, we are supportive of reforms in the industry that improve the outcomes for customers and, equally importantly, improve the confidence of the Australian community in the financial services industry and the financial planning profession. And we're very supportive of many of the FOFA reforms. We don't agree with opt-in. With the move away from commissions and with the fiduciary responsibility that will be imposed on planners, which we very much agree with, we just think it's a needless expense that won't lead to better outcomes for consumers.
Do you think the regulations will lead to a significant drop in mid-tier players, as some suggest?
Well, that's hard to gauge. I think there are proposed changes in the FOFA reforms which will go to potentially affecting the financial viability of potentially some smaller planner practices or businesses in the industry. I think that would be a negative outcome. I think healthy competition and robust competition from big and small and varied players is a very good thing, and it tends to result in better outcomes over time in terms of improved quality service for consumers. So I think it's important that whatever the outcomes, we continue to see robust growth in the industry and very strong competition.
Craig Dunn, you must look forward to AMP reaping the benefits of all these massive changes. Thank you so much for joining us.
Thanks very much, Tikki.